Welcome to the Visionary Connection, where we connect with you. Today, we will be talking about reasons to refinance. Lean back, made simple. In today's market, in today's environment, interest rates, they say are at historically lows. And, that is true, definitely for the most part, that I have seen since I've been a mortgage broker, since I've been a mortgage loan originator for the past at least 13 or 14 years. There's a lot of people out there, obviously, with so much more experience. If you were in the mortgage game, or if you had purchased a home in the 80s, rates were anywhere between 11%, 17%, and that was considered normal. It really depends upon the economy, but today, most of the rates that I've seen, the 30-year fixed on down, are somewhere in the high 2s, maybe the low 3s. It's amazing in terms of being able to borrow money for such a low amount. So if your interest rate is fairly high, meaning anywhere between 3.75% on up, I would highly encourage you to look into refinancing your home. So let's get into this and let's talk about a few things. So number one, lower your interest rate and save money, right? It's very simple, very plain. So let me give you just a very basic example. If your interest rate right now is 4.25 on a 30-year fixed, for example, and your monthly payment is $2,150. Well, depending upon how much equity you have in your home, depending upon your credit score, depending upon various qualifying factors, you could very well get that rate down to, let's say, for example, 2.875 on a 30-year fixed. That would save you hundreds of dollars, literally, per month on your monthly payment. Now, let me qualify that with this. For individuals who have higher loan amounts, higher balances on their mortgage, meaning you owe $300,000, $350,000, $400,000, $450,000, $500,000, the more you change, the more you lower your interest rate, the higher impact it will have mathematically. Just simple math. If you owe $120,000 on your mortgage and you lower your interest rate significantly, it's not going to have as big of an effect because you don't owe as much interest on the principal because your principal is not that high. So you're not going to see the same effect that someone who has a higher balance on their mortgage would. But regardless, in the long term, if you plan on owning your house for several years or more, you will save interest per year and you will save money per month, which is real money in your pocket for your budget, for yourself, and for your family. So definitely consider that, number one. The lower rate typically, at least as I just mentioned, 0.75% to 1%, okay? So 0.75% to 1%. In the industry, we call those basis points, okay? But if it doesn't really make sense to go from a 3.25 to a 3%. It doesn't. Why doesn't it? Number one, you're not going to have a huge change in your monthly payment. Number two, you will have closing fees. Closing fees are a part of doing any refinance. You have to have title insurance. That's done, again, lender's title insurance, not owners. We will get to that another time. If you pay your taxes and insurance in escrow, they have to re-escrow. You will have new bank fees. You will have new per diem interest, depending upon the date that you close in the month. So you're going to accumulate new costs because it's the cost of doing a refinance. And to save $80 per month, to save $47 per month, that's not going to make sense. So you want to make sure that it does make sense. Okay, in the mortgage world, that is called a net tangible benefit. Okay, in the past, you could do that refinance and probably get away with it, but it wasn't a benefit to you. Mortgage laws have changed so that it benefits you, the consumer. It protects you, the consumer, so that you're not doing something and you're wasting your money. It's called a net tangible benefit. It's designed to protect the consumer. So that's good news for you. Okay, just mention that. Save monthly and yearly on your interest paid. We just mentioned that. So if you have questions, definitely give us a call. Check us out. We will be more than happy to explain that to you and actually go through some real numbers with you. Of course, free of cost. We love to educate. We love to connect. That is what it's all about. So let's go to number two. You can take cash out, okay, using available equity, cash out. What does that mean? So the equity in your home, the actual ownership in your home is the difference between how much your house is worth, the appraisal value, and how much you owe on the mortgage. Okay, that difference, that space there is your actual ownership. It is your equity. In order to use that equity these days on non-VA loans, okay, you need to have at least 20% equity there because it's more risky for the bank to allow you to take out equity from your home where you don't have that much really to use, especially in a COVID environment with regard to the market and how some of the mortgage guidelines have changed. So, but that equity is yours. It belongs to you and you can use it for a variety of reasons. You can pay off debt if you have a lot of credit card debt, or if you have some student loan debt, or if you have a high payment on a personal loan or a high payment on your car note. You may want to go ahead and just pay that off, for sure. I would highly recommend that. You may want to do some home improvements, okay, depending upon how much equity you have. You may want to put down hardwood floors, you may want to paint, you may want to do this or that. It's really up to you. It's your home. But again, you do have that equity that's available in order to use it in ways that are advantageous for you and your family. You decide, okay? Again, you need equity to make this work. I can't emphasize that enough. So let's say, for example, your townhouse is worth $346,000, but you owe $320,000 on your mortgage. You do not have enough equity in your home in order to take it out to use it. You have to have what's called a loan to value, okay, loan to value of at least 80%, which means you have 20% of equity, which essentially is going to be a little bit over $60,000 you would have to have available in order to take that out. Now, as I had mentioned here, the exception is for VA loans. If you are a veteran, you can go up to 100% loan to value. What does that mean? You owe, let's say you owe $280,000 on your mortgage, and your home is worth $320,000. You can take a loan out to $320,000. Okay, let's say you owe $417,000 on your mortgage, and your house is worth $480,000, $490,000, somewhere around there. You can use that full $480,000 and $490,000. What happens is you have to pay off your mortgage, the existing mortgage, which would then leave you whatever that difference is minus closing costs. So you might get $50,000, $60,000 to use. That is only for VA loans, as VA loans are fantastic and have many, many different benefits. If you want to learn more about the VA loan benefits, we just had a fantastic podcast with Mr. Dario Santana. Point here, as I'm pointing, click here for that particular video, and you will learn all about it, okay? Number 3, reduce or change your loan term. Okay, what does that mean? Your term is the number of years that you are going to be paying back your mortgage. Most people, by and large, do a 30-year fixed. Why? Because it has the lowest monthly payment. Your loan is stretched out over a 30-year term. As a result, your monthly payment is the lowest. Now, there are some people who will say, okay, well, if I lower my interest rate, what if I lower my term to 25 years or to 20 years? If the difference in your monthly payment is not gigantic and it's going to hurt your budget, I highly recommend pay your mortgage off sooner. Why? Mathematically, depending upon your loan amount and how much your interest rate is and your monthly payment, you will literally save tens of thousands of dollars, if not hundreds of thousands of dollars over the long term. Okay, so that is extremely important to take a good look at and to get a good understanding of. We just talked about this. You can go from a 30-year fixed to a 20-year fixed, or maybe a 25 to a 15. Again, if it works in your family's budget, if it works in your particular budget, to pay your home off sooner and to own it, right? And all you have to do is pay your taxes and your homeowner's insurance. Think about what you could use that extra money for in terms of your retirement, in terms of charitable giving, in terms of helping people, in terms of investment. There's a variety of different things that you can do so that you don't have that stress and that worry or potential anxiety about your mortgage. A lot of times, we need to sacrifice. We need to be financially responsible. And as Dave Ramsey shows in some of his videos, he shows the deer running from the cheetah or from the lion. Like, you want to run from debt as quickly as you possibly can. Is that possible for everyone? Absolutely not. I'm not going to sit here and share something with you that I feel is unrealistic. However, if you are in a financial position where you are able to shave it down a few years, that's highly recommended. There are major benefits to this. As we talked about, when you lower your term, you will increase your monthly payment. So if you go from a 30-year fixed to a 20-year fixed or to a 15-year fixed, why would your monthly payment go up if your interest rate's going down? Well, it's because you're paying your loan off more quickly. You're paying it off sooner. As a result, the more quickly you pay it off, you have to pay more in your monthly payment. What does that mean? More money will go toward principal and less money will go toward interest. Mortgages are a funny thing. When you have a 30-year fixed, they are what's called front-loaded. So the first at least maybe 5 or 6 years of your mortgage, the vast majority of your payment goes toward principal. Why? It is designed that way because the banks know that you may or may not stay in that house more than 5 or 6 or 7 years. So they're going to get their money from you as quickly as possible, okay? But when you lower your term, mathematically, the quicker you pay it off, for every dollar that you pay, more cents of that dollar has to go toward principal versus interest. As a result, you are going to then pay the principal down more quickly. There's less interest that can build up on top of that principal, and you will pay your home off much more sooner. So there's one thing I want to mention that I didn't write down here is what's called bi-weekly payments, or a way to pay off your mortgage more quickly. Okay, so you can Google this, you can research this. There have been lots of videos on this. So some people say make an extra mortgage payment per year. Absolutely, that's one way to do it, because what happens is the quicker you pay down your principal, the interest cannot accumulate on top of that, so you won't prolong your mortgage. Or you can add principal payments on top of your mortgage every month. $50 helps, $100 helps. The more you can put on there, it actually helps, but it has to be cumulative. You have to do this over a long period of time in order for it to work financially and mathematically. What I personally do on my home is what's called bi-weekly payments, okay? Let me give you an example. If your mortgage payment per month, principal and interest, taxes, and homeowners insurance is $2,000, the bank every 2 weeks on a specified date, they will withdraw $1,000 from your account every 2 weeks, okay? They will apply that $1,000 to your mortgage balance, okay? Your loan will recalculate or re-amortize. So every 2 weeks, you're paying down a little bit of principal, a little bit more interest. The next 2 weeks, you're paying down more principal and more interest. Well, guess what? The quicker you pay down the principal, the more that your loan recalculates, that interest again cannot accumulate on top of that principal. If you do that, if you have a 30-year fixed, Google it. Google a amortization table and bi-weekly payments. Check it out and reach out to me if you find something different. You do that on the 30-year fixed, you will shave off between 5 and 7 years of your mortgage. Very simple, very effective math, okay? If you do that, you will save yourself, again, if not tens of thousands, hundreds of thousands of dollars depending upon your mortgage balance. So I highly recommend that. It helps you to be financially secure. It helps you to be financially responsible if you are in that position to do that. So again, let's reiterate. Let's go over the reasons to refinance. Number one, let's lower that interest rate and let's save money per month. So that is by and large the main reason why people refinance. Fantastic. I've done it. If you can do it, great. Number two, you take out cash. What's called a cash out. You take out equity from your home for a variety of different reasons. You want to pay down student loan debt. You want to do home improvements. You want to pay off a car. Have some money in your pocket for whatever reason. If you have the equity and the interest rate doesn't go much higher and the monthly payment makes sense, right? That is actually a net tangible benefit for you for sure. The third reason is you may want to change your loan term. You may want to, let's say if you're currently in a 15-year fix and the payment's just a bit too high for you, okay, well then go to a 20-year, 25 or 30-year fixed, right? And even though you're moving in the reverse, you are helping yourself financially monthly because it's not a burden. Or if it's the opposite, if you have a 30-year fixed and you want to go down to a 20-year fixed and pay your home off more quickly, as we've talked about, then that's also a benefit for you. The most important thing I would encourage you to do is to consider it financially. Look at it on paper, consult a mortgage professional, know what your options are, make sure that you are fully educated, that you see the full picture, and that you understand and that you feel great about your decision. So thank you so much for watching this video. Check out all of our other videos on our YouTube channel. Send us comments and send us some correspondence if there's anything that you want us to talk about or teach on. We'd love to do it. See you next time.